We've had a big 24 hours of central bankers. So firstly, we're going to focus on what Jerome Powell said yesterday at the FOMC presser, and then we're going to move on to some comments that have come out of the Bank of Japan overnight. What's going on there? And the trading takeout today is going to be why you need to use volatility stop losses and not just throw in your stop where you think is right to do so. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So yesterday, the Federal Reserve kept rates on pause, and the market had expected this. I mentioned this earlier in the week. They'd expected and priced in rates pretty much at 100% to be kept at the same level at this meeting. But the market has taken Powell's comments afterwards as being very, very dovish. And what that means is that they expect now for rates not to go higher. The comments that I've got here in front, and just for full credit, this is Arno Venter who has provided this document to us. So he's a fantastic follow, by the way, on Twitter. But the comments here are the key bits from the press conference. And I can understand why the market has interpreted these comments as being dovish. Now, I'm going to highlight some of the key ones that I believe, and it's here. It's much closer to being consistent with inflation at 2%, which is in reference to the ECI. I think that's the Earnings Condition Index, I believe. I can't remember the exact definition, but basically it's to do with, costs of things. So inflation at 2% is key because that's obviously their target. Okay, so that's one focus of, okay, we don't really need to hike rates more, or at least the market is being guided into the Fed not wanting to hike rates more. Wage increases have really come down significantly over the last 18 months. Of course, that was a key driver of inflation as well. And for me, inflation expectations are in a good place is another one. And he's reiterated that twice, actually. So one of the things that I guess the central bankers know these days is that algorithms are probably running heavily on the market, and they use NLP, which is neuro-linguistic programming. So they're listening out for certain phrases and things like that. Reiterating inflation expectations a couple of times are probably going to cause a bid to get into the market, to be honest with you. The algorithms are going to pick that up and say, yeah, we're going. Things like good news is we're making progress. People can see that inflation's coming down. But the key bit for me is how he's referenced all of this, especially the component that I spoke about there, where he's saying about restrictive. Let me find it. It was just here. Here we go. Within a range of estimates of the neutral rate policy as restrictive. So you've got loose, neutral, and restrictive monetary policy. Okay. So loose monetary policy is low rates, basically. Neutral is when rates are raised, but nothing's being affected in terms of the labor market just yet. Restrictive is when the labor market tends to be affected. So central banks are going really for full employment as best possible, but to cool the economy down, they have to reduce employment. It's just a factor. And this is known as a relationship called the Phillips curve. They've abandoned it to a certain extent, but I think they're bringing it back now. And the fact that he is juxtaposed, it's a big word for me, juxtaposed the restrictive part, let me just get it again, just so I can see. Yeah, within a range of estimates of the neutral rate policy is restrictive. So there's that sentence, but then at the very end, he says, we aren't confident financial conditions are restrictive enough. This is absolutely key for me because the market has taken this whole speech as being massively, massively dovish. Whereas the way that I would look at this is the market from where it's rallied now has set itself up for a hell of a lot of pain. So if we look at where it rallied from, so roughly here, we're looking at 42.20 as a key marker, a key line in the sand here, because this is where it started to tick up from. Now, my view here is that we've got a hell of a lot of buying going on here, but we've not actually seen that much follow through. It's only up 50 points, which relative to previous history is not that great. Now, the way that I would now look at the market on the ES, so sorry, this is ES E-mini futures. We've got a new range here. We've got a new range form. We can drop this down to here. And the way that I would look at this is the range that is being played now. 42.90 between 42.90 and 42.50. So there's a 40 tick range there, 40 point range, sorry. But this origin is key for me. This is absolutely key. My view is that because we are seeing data deteriorate, yesterday we had the ISM manufacturing PMI come out and it was worse than expected. I think it was 45.2. Let me just double check that. 45.2. Let me just change the date. What's the date today? First search. Sorry, I've got the wrong date on the chart. Let me just view it again. So we had ISM manufacturing yesterday, and it was 46.7, but the expected was 49. So that's pretty bad. So let's just go back to this chart again. No, I was correct. Sorry, I was going crazy then. So yes, I think with that deterioration in data, there is something significant to look at there, where the Fed, if they are forced to cut, and I mentioned this yesterday, if they're forced to cut or pricing cuts closer, then it will be because of deteriorating economic conditions, which has an effect on growth. Now, the stock market will not like that, because we've already seen what deteriorating economic conditions can do to the market back in 2020, except there's no real reason now for the Fed just to turn on the printers again. It's part of a normal-ish cycle. Unless we get a massive financial meltdown in terms of banks going kaput and, liquidity completely drying up, I don't see the printers being turned on anytime soon, which is not good for equities. Equities are so used to, when things turn bad, those printers coming back on and the market getting bid up. So I would definitely look at this as a pain trade. I still think, there's plenty of momentum to continue up to this high, this key high here at 42.90, maybe even tick up to 4,300, get a load of people in long, momentum algos jumping into the market. But I do think that there's pain here where people got in. I really, really do. So watch out for that, and watch out for any sharp moves back to the downside after highs have been touched. And now onto the Bank of Japan, and they're becoming more and more important as the days, seconds, even milliseconds go on, to be honest. Reason being is because Japan has been in unconventional monetary policy for 20 years. But with every day that moves closer to their next meeting, it just seems like they can shift out of that. I mentioned earlier in the week about them exiting more static sort of yield curve control. They've made it more flexible now. And this is giving rise to exactly these comments that are below here. So this is from New Squawk. If you've not got a New Squawk subscription, I definitely think you should get one. It really, really helps. Bank of Japan Governor Ueda will stick to a pattern established to move gradually towards an exit while maintaining the dovish rhetoric of his predecessor. Given the uncertainty on the economic outlook, the BOJ will probably want to wait until at least spring 2024 and normalising policy. If so, it makes sense to keep guidance dovish. This is always going to be yen negative. Okay, so if we look at dollar yen quickly, let me flip over to dollar yen. You can see the way that it just keeps reacting to these market events. It's like you just get a crazy spike and then it just goes insane again. So you can see that we made a double bottom here, and the play for me, you don't even have to go further into the comments here. The play for me is to look at these two key components. So we've got this low here. Okay, who's been buying there? People pretty heavily. You can see the the long tail there. Sorry, I always forget that I do things weird and I don't use candles. You can see, but just as a side note here, I'm going to digress a second. The reason I don't use candles or use green and red is because I want as little emotional input into what I see. I don't want visual input of green and red. So I use the bars because it gives me just open, high, low, close. That's all I care about. I don't want to see red and think, oh God, that's bad, because it's not, or green, oh, that's good. In FX, it doesn't matter, So just to digress anyway. But these are the tails that I'm talking about where buyers have entered. You can see buyers came in here briefly. This candle came and just knocked them out, whoever had their stops nice and tight. Same's kind of happened here, actually. So I'd be looking at this market and thinking to myself, all right, so we either come back down here and shoot back up, or we just rally on from here now. And the reason for that is because nothing has changed, really. They're saying that they might exit policy in spring, but they're not. They're saying they're keeping the dovish rhetoric. So in this environment where we are a bit risk off, I say we're risk off. Over the longer term trend, we are a little bit risk off over the last couple of weeks. So the dollar is still getting bid, which means that I think the yen will, come under some flack there still. And you can see that all we've done really is trade into these prior sort of lows down here where we flew off previously. And the market doesn't know what to do here in the last sort of 2-3 hours or so. It's kind of just made this massive doji. It's already grabbed all the way down here. So I think the path of least resistance is back to the upside, especially if people have been selling so heavily overnight as well. You can see here, there's been heavy selling. So on the yen, you've got back to origin, which is basically 151. Wouldn't be surprised if we get there. You've also got people that have started selling early this morning here. So, this sort of double top pattern here, if we go into a smaller time frame, you can probably see that a bit better. People have been selling here. Nice little area of support turned resistance here. So the way that you've got to think of things like this is, okay, where are people who are stupid doing business? People that are stupid are doing business here. They probably would have been selling, looking for a further breakdown. That's why we traded back up and then traded back through afterwards. So what are they probably going to do again? Probably going to do the same thing, which gives you some room to come and take them out. The same thing up here. There's probably still people selling here and here. And there is a pain trade when stops get smacked. There's a cascade that occurs, especially in FX. And with the volatility that's coming out at the moment, with central banks sort of pivoting on their policy, coming out with comments all the time, these are the kind of trades that work really, really nicely. You can see that we're almost bottoming here already. We've got 1, 2, nice little double bottom. Wouldn't be surprised if we just continue on to the upside, especially with comments like keep guidance dovish. There's no change, basically. There's absolutely no change. This is probably the most sort of hawkish comment. Next focus is ending NIRP, which is no interest rate policy or negative interest rate policy, sorry. They're timing to move around spring. That's far away. It's like 3-4 months away. So I wouldn't be paying much attention to this outside of it makes sense to keep guidance dovish, basically, which is negative yen still. Do you ever find yourself getting stopped out all the time around highs and lows? Well, it's not your broker's fault, unfortunately. It is absolutely your own fault because you're putting your stop at very, very clear places where other people are going to put their stops as well. There's a reason why Citadel, for example, buys retail trader flow, and they actually call it uninformed flow because retail traders, unfortunately, do silly things all the time. When you have too tight a stop or you put it in silly places, what's going to happen is the market is automatically going to pick you off. It just is a function of how things occur. So how can you remedy this? Well, my number one tip is to, rather than use arbitrary stops where you think you're right to put them. Use stops based on volatility. So you can look at things like the daily expected move, which is derived from, the implied volatility of an asset. Or you can use average true range, which is probably an easier one just to work out because not everyone has implied volatility data. But average true range can work much, much better. And it's important always to try and systemize your risk management rather than making it subjective. Shoving a stop at a high or low is not going to work, basically. Always try and systemize, use ATR, use some form of volatility indicator that works for you.